I think the best explanation that I've heard that people can relate to is it's similar to what happened in the movie It's a Wonderful Life. And there was a run on Jimmy Stewart's bank, and the people wanted their money, and they said, "Well, your money's in at, you know, Tom bought a house and June bought a house. Those are your neighbors. There's where their money is. So I don't have it." And so, in this case, with the Silicon Valley Bank, they invested the depositors' money in longer term marketable securities, and when interest rates went up, those securities lost value. And so that in itself isn't necessarily an issue. There's a lot of banks that are in that same position right now. But what happened was because there was a concentration of these startup businesses and the CEOs all talked to each other, it caused a run when the first CEO of a tech company pulled their money out. They subsequently talked to other CEOs and they followed suit. And so because they didn't have the liquidity to give the depositors all their money back, they had to sell marketable securities at losses. And so it made the bank insolvent. And so it was and so that's why the regulators came in, was to due to the safety and soundness issue.
Would the bank have not gone under if basically the word on the street hadn't gotten out? Like, it's almost like a whisper campaign. Hear what's going on, hear what's going on here. And it set itself into its own panic, right? Would the bank have been okay if everybody didn't panic?
It would have definitely been okay if there was no panic. They would have, it would have been, it's a paper loss. So, on this marketable securities. So typically you're not going to sell something you're going to have a loss on. And so they would have worked their way through it. The securities would have matured. They would have reinvested and at better rates and things like that. So it was the panic that occurred by these companies that had large amounts of cash within Silicon Valley Bank.
And FDIC, we see that every time we walk in, Triad Bank, any bank has the FDIC, and the number is always 250,000, right? So
Yes.
if you're an investor, if you're just a customer and you have 500,000 in that account, it's only insured up to 250. But it sounds like, from what I've read, a lot of people had a lot more than that in these accounts.
So I think there's a difference here for like an individual who's got money in the bank, 250,000. We can also structure that to where you have named beneficiaries, so you can have a lot more insurance as an individual by how you title an account. And so we're very good at that here. Our Karen Reed in our lobby, our people are trained. They know how to help people, individuals.
That have large amounts of money.
Right. And so the difficulty is for a corporation who's got millions of dollars, you can't title in different names. They need access to their money to facilitate their business and pay people and payroll, and so it's just not it's not convenient to have money spread. If you got $10 million, you're going to have it in 20 different banks. It's just not.
So feasible. Is that FDIC really just for individual? It doesn't necessarily.
They do have the coverage, and there is another thing that we do for corporations and things. It's a company called IDS where they will take the money and they will disperse it between other banks, and then in return, they take other banks' clients and put money in to our bank. So it does spread it out, and that's usually for like public funds, money that's not going to be operating necessarily. So it's truly, what has occurred, and I think really is going to be the interesting issue here is, and I hope it's just not me having a knee-jerk reaction, but I do believe that the insurance system needs to be revamped. Think about the fact that since the FDIC insurance came into effect back in the Great Depression. And so they've increased it over the years, most recently back in 2008, where they increased it from 100,000 to 250,000. The problem is that our country has grown. Our gross national product, we're a much bigger GDP than what we were back in the Great Depression. You couple that with all of the stimulus money that's been put into the system, that money has to go somewhere. And it's virtually impossible to have it all insured, unless you're really going to go great lengths and make that your full-time job, just moving your money around. But so it really does. I think hopefully it woke up the people in Washington D.C. and the FDIC, and I'm sure it has. Now, when I say that in terms of we need to do something different, and it needs to be a tiered system, and you got to know how many bank clients are uninsured because of the amounts that are in the bank. I believe that the bank should pay an insurance premium to the FDIC to cover all those deposits. And I think they need to build up the fund, because here was what I really found interesting is I'd never heard of Silicon Valley Bank before last week, and the other bank up in New York or whatever. But with Silicon Valley Bank, we actually had clients here who had accounts with them. I called our legal counsel over the weekend just to hear what they were, because remember, they hadn't really determined what they were going to do with this bank. It was going to create. So I called our legal counsel to kind of see what they're hearing. And they actually had a tech division, and Midwest law firm with a tech division that had a lot of clients that were banking with Silicon Valley, and they were working with them to get their money out. And so to believe that it's just an isolated case, that it doesn't have ripple effects, is naive. I was, naive on my part, because I would have bet $100 that nobody had Silicon Valley accounts here. And so that's a real thing. You can't have companies being wiped out of their deposits and they can't make payroll and pay people. So it's something that we have to look at as an industry, and from a regulatory side, and from an industry standpoint.
And so when the government says we're going to cover everybody's money, you're not going to lose your money, and I get it, they don't want mass panic and chaos across the country. Whatever your politics are, they don't want chaos. They don't want everybody running to the bank. But then they say it's coming from this fund. What is that? Like banks pay into, or is that something new?
No, the fund's been there for a long time, and it's based upon how risky your bank is. You pay an annual assessment to the FDIC for insurance. So that's been there forever. They depending on the economy, they could increase the amount to make sure there's enough funds available. If there's, like in 2008 and 9, when there were all those bank failures, they increased, the premiums that we paid the FDIC fairly significantly.
So there is money there to do this. It's when they say it's not taxpayer money, that's accurate.
That's accurate.
And do you think Silicon Valley, was it risky banking, or was it just bad luck?
A combination. I think they ignored one of the basic banking 101 in terms of managing your interest rate risk. And so what they did was they took short-term volatile deposits. They're volatile because you have immediate access to them. Nothing wrong with that. And invested them in longer-term marketable securities. And so that was a mismatch related to short-term liability funding a long-term asset. And so that's not good practice. Where I think it probably would have been okay if we didn't have inflation, which made those marketable securities they bought lose value. And so we hadn't had inflation in 50 years, so I could see why someone would say, what's inflation? How is that really a factor in my interest rate risk program? But it is one, and obviously we see that was something they probably miscalculated.
Is it an international story now? I know where Swiss Bank was mentioned and things were happening overseas. Do you think this does have a ripple effect across the globe in terms of consumers or the banking industry? Where does it go from here? That's the most open-ended question I could come up with. Where does it go from here? But does it change things dramatically, or is this just kind of a blip?
I think it all kind of settles down. I think in 30 days it will be forgotten for the most part, other than bank regulators changing how they examine banks now.